Salam, TTB. Welcome to OCBC and ISP's One Wealth Outlook Market Update, a special edition for the Easter weekend. My name is Sagara, and today I'll be bringing you our thoughts and outlook on global and Indonesian markets, all to help you make the best investing strategies and also understand what's driving markets today. So let's get started. As the crisis in Ukraine continues, with more tragedies unfolding each day, markets still have actually become less reactionary to new headlines related to Russia's invasion. For now, it looks like peace negotiations are at a dead end. Russian President Putin has vowed to continue the invasion with a renewed focus and intensity on eastern and southern Ukraine. So this strategic reprioritization has allowed the Ukrainian government a moment to breathe, but it makes it less likely that we will see a return to normal trade or production for essential energy and food products from the region anytime soon. Commodity prices, already in a structural supply shortage pre-war, remain elevated since Russia and Ukraine are both key global suppliers of essential goods such as oil, natural gas, wheat, and iron. We've previously covered this issue and analyzed the impacts in previous market updates. On Tuesday, the World Trade Organization forecasted that the ongoing conflict has dealt a severe blow to the global economy and may cause global trade to actually be cut in half for 2022. Now, this is a grim prediction, considering the underlying supply chain crisis that has already pushed inflation around the world to multi-decade highs. In the US, we saw Tuesday's CPI mark inflation at a 41-year high. While in the UK, they saw inflation jump to a 30-year high. And for the rest of the G7, they're not far behind, ex-Japan. This accelerates the possibility of a widespread cost of living crisis, especially among the developed nations. Wednesday's US PPI surprise upside reading indicates that although the core inflation and consumers may be softening, more inflation should be expected in the pipeline. So what does this mean? Households are getting poorer in real terms, and prices may soon be reaching demand destruction levels. This is where prices have risen to the level that consumers no longer have the ability to purchase goods, since wages have failed to keep up with the inflation. In such a case, a slowdown in growth and ultimately recession would force prices back down to earth. Now let's take a look at Asia for a second. Hong Kong and China are actually beginning to slowly relax COVID measures in some places. At one point, they had strictly locked down key manufacturing and service hubs such as Shenzhen, then Shanghai, and now segments of Guangzhou. Now, this is due to the rising number of infections of the COVID Frankenstein XE variant. The most impacted industries have been electronic and car manufacturing, such as Apple and Tesla, as they are forced to idle production. This is a blow to industries that have been negatively impacted by the global semiconductor shortages. In the past few weeks, the lockdowns have weighed on Chinese assets despite what appeared to be a PBOC put on February 15th and March 16th. So they injected further liquidity into the economy, as well as encouraging long-term investors to enter the market, as well as facilitating corporate financing. Yet China's PBOC stands largely alone in this action. Elsewhere, central banks have been forced to intervene and enact quantitative tightening measures. Now, by both hiking 50 basis points or multiple 25 basis points, as well as rapidly running down their balance sheets. So they hope to put the brakes on their respective economies in order to tame inflation and engineer a soft landing. Multiple indicators have sounded alarms since the Russian invasion of impending slowing growth. Some suggesting that central banks will have a hard time in trying to engineer the soft landing and prevent a recession. So the most discussed indicator being the US Treasury yield curve, which is inverted at several points for a time. Now, this is where suddenly the coupon for the shorter 2-year and 5-year duration bonds are higher than the longer 10 and 30-year. So what the inversion indicates is that short-term conditions, as uncertain and volatile as they may be, appear better to investors than long-term prospects. Other than that, we also see sales of heavy trucks and automobiles falling sharply, as well as freight volumes. This is a leading indicator for the health of the US economy, as almost 2/3 of Northern American freight is moved by trucks. But again, these are not imminent or immediate indicators. Rather, they're signals that we should take note of that greater recession risk is in the 6 to 12 month window ahead. there remains many opportunities to take advantage of, and actually parts of the market have remained very resilient. How has Indonesia and its currency and markets held up during this increasingly risky investing environment? As a commodity currency, you'll be surprised to hear the Indonesian rupiah has remained resilient and stable throughout the war and the start of the US Fed rate hiking cycle. And this is a first for the rupiah, as it has previously behaved much more sensitively to global risk events and volatility. With the continued trade surplus increasing exponentially due to demand in energy, commodities, and palm oil, we seem to be in a good position. But along with the strength of its currency, the strength of our equity index and equity market is also something to take note of. The JCI continues to climb, over 10.41% year to date, and is essentially tied with Brazil's IBOV as the best performing equity index globally. Foreign inflows into Indonesian equities remain strong and consistent in the past few months. Recently, the largest IPO in Indonesian history, Gotoh, pushed the JCI 2% over earlier all-time highs to the 7,354 levels intraday. Although Gotoh itself has actually already come down in the days since its opening price, the surrounding interest and attention of Indonesia's largest decacorn and e-commerce platform IPOing has continued to support the rise of Indonesian equities generally. Now, this performance likely goes back to our significant commodities and financials exposure. As long as there continues to be strong demand for our raw and plentiful resources, Indonesian assets, as well as its market share of global trade, should grow. Looking ahead, first quarter earnings seasons has gotten underway, starting with the US financial institutions. Now, the tone and narrative set during the calls are likely to cement expectations and fears of the difficult position that investors as well as central banks may be in. We're going to have to see and have to stay flexible. From us here at OCBC and NASP, that has been our One Wealth Outlook Special Edition Easter Weekend Update. To access more of our market updates and our weekly market journal, click the following link, as well as follow us by clicking subscribe button below. Have a lovely Easter weekend, everyone. Stay safe and remember, tidak ada yang tidak bisa.